This is Rachel. We're really excited that we're adding NGL as one of our core partners for our traditional long-term care business. And Mark Glickman is going to be our main contact there, and he's going to go through the sweet spots of the product today and kind of show us how they stand out in that marketplace. So I don't want to take any of your time, Mark. Let's go ahead and get started.
Okay, very good. Thanks so much for attending. This will be a high-level introduction to the product. We're going to cover a lot of material today. For those of you on the call, feel free to raise your hand or jump in if you have any questions. Even if I talk fast, just interrupt me. Just a quick introduction. My name is Mark Glickman. I'm an actuary by background, but I've moved over to the sales side, trying to get people long-term care solutions. And you guys know how important that is today. So this is a new long-term care solution that we're bringing to market that's addressing a lot of gaps, especially in the traditional long-term care marketplace. I won't go into too much more detail about my background, but I want to talk to you about the company LifeCare that I work for. We are a home office administrator for all of the carriers that you see here. Again, we've worked with companies ranging from Allianz through Lincoln Benefit Life, State Life, Mass Mutual, and the newest carrier on the block is National Guardian Life. So while these carriers are not affiliated with National Guardian Life, LifeCare administers all the policies for the traditional long-term care products for these carriers. And that means that we have a lot of experience in the marketplace, about 30 years, as you can see here. And National Guardian Life is a new carrier to long-term care, which is really important because you're not going to hear a lot of the negativity associated with past rate increases for them, obviously, because this is their first product. But they get to hit the ground running with all the experience that we bring to the table. So this is a partnership. National Guardian Life is an A- carrier, a mutual company, very stable. They've been around for over 100 years. And they're going to be approved with this product, we expect, in all states. So again, those are the kind of the highlights, the most important things about the carrier. If you do have other questions, we have some backup materials that can help you explain that to other advisors that you work with. Today, though, I want to focus more on the product and the sweet spots and where to focus in on if you're looking at this for the first time. I'm going to follow up this with a presentation that's called Benefits Buddy that's going to show you visually all the things that I'm going to talk about here. By the way, I'm going to turn off my camera so you can see my screen a little bit better. Just want to kind of introduce myself first. So here, the first thing that you're going to notice about the product is we brought back to the traditional long-term care space lifetime benefits. And the reason why we feel comfortable doing that after 30 years of offering these features is that we take an approach that your clients that have longevity risk, the healthiest of your clients, are going to get the most benefit, the most bang for the buck buying traditional long-term care. And if they are qualified, then they tend to go on claim between ages 80 and 90. That's kind of what we see in our statistics. When people go on claim at those ages, the lifetime benefit risk is a lot less scary for the carrier in terms of catastrophic costs. And therefore, we feel comfortable offering that in the marketplace. So this is really going to be a core focus of ours is you're going to use the different products that you work with, oftentimes after pre-qualifying them based on whether they're going to qualify for traditional versus a life combo versus a long-term care rider versus an annuity product. I like that health-based funnel approach because that will direct them to the right product for their particular health situation. So I'll focus in a little bit more on that, but that's kind of where our sweet spot is if you have healthier clients, we tend to have the best, I'll say, customer value. Now, a lot of people can't afford lifetime benefits in today's marketplace, and I take more of a budget approach when I'm working with advisors today versus a cost of care approach. Because I think most people don't buy traditional long-term care because they think it's too expensive or they're worried that it will become too expensive. Okay, so when you look at this product, when you have healthy couples, we have a shared care rider, very unique in that it gives a third pool of benefits. So it adds on about 50% more coverage to the plan, which means that you can really extend out the benefits but keep the budget much more affordable. So I'm going to show you this in a few moments, how it works with a few case studies. But keep in mind, this is one of our most popular features. Another nice thing about the shared care rider is that if one of the individuals in the couple passes away, the survivor actually gets to keep the third pool of benefits. So very often we might see a joint policy with buying 5-year benefit pool, which gives each of them 5 years, okay, so 10 years. And then they can add on a third pool, which adds up to 15 years for the two. If, let's say, the older husband passes away, the younger wife now inherits the 5 years that he didn't use, and she has a 10-year benefit period. So this is how we can grow benefits so that they become much, much closer to lifetime, but yet keep the cost very affordable. Another thing that we're bringing back to the market, and this is another critically important feature, is single payment and 10-year payment options. So of course, we have the lifetime pay, and a lot of people, in fact, most people select that because they like to spread out the costs and keep it more affordable over time. But these options are critically important because guess what? They take away that fear factor about my rates are going to become too expensive, right? They're worried about rate increases. The single payment option is a guaranteed premium. So when they talk, we talk about traditional long-term care, it doesn't have guaranteed premiums. Single pay is guaranteed. After they pay their premium, it becomes a non-can policy. Okay, so it has a guarantee. The 10-year payment becomes non-can after the 10th premium. So it's guaranteed after the 10th year. And again, the likelihood of rate increases is much lower on today's traditional products in general. On the 10-pay, a rate increase in the first 10 years is very unlikely. But again, they're done after 10 years, so it mitigates the rate increase, right? They can't have any more rate increases after their 10th premium. Another reason that these are critically important in today's marketplace, as many of you know, is it's a great way to get clients planning for long-term care if you understand their balance sheet and you know how they're allocating their assets in retirement. And of course, the asset-based products have really thrived on, taking a CD or a dormant asset and repositioning it to pay for a clear need for long-term care. Because if they don't insure the risk, they're by default oftentimes self-insuring the risk. And these products are a much better way to self-insure or even insure the risk, as you guys know. So repositioning assets you can do because of the single and the 10-year premium options. I'm going to cover this in a little bit more detail, but you can also take life insurance funds or non-qualified annuity funds, and you can reposition those assets to pay for long-term care via a tax-free 1035 exchange. The reason that this is so important in today's marketplace is we haven't had a single premium payment traditional option on the market since the Pension Protection Act was released. And what that allows you to do, of course, is do this exchange in one transaction to traditional long-term care, get all the leverage, all the protection that you get from traditional, a guaranteed premium, and you can even add return of premium, an asset-based solution to this as well. So the 1035 is one of, I'll say, our hottest new markets. And again, this is really the first product ever that's been able to do this because of the single premium option on a traditional product. And then the fourth one, which again I'll cover in more detail today as well, is business owner situations. Long-term care is considered health insurance. Life insurance products aren't allowed to deduct premiums typically for businesses, but for health insurance you are allowed to deduct the premiums for a business. And really the 10-pay option is the one that's used most often in these situations, in that if you're a business owner, you can use a 10-pay and you can deduct the premium as a business expense. And unlike disability income, when you receive the benefits, they're still tax-free. Okay, so it's a really incredible tax-advantaged opportunity. Very few people are aware of, very few people are taking advantage of. But when we think about how many businesses there are in the United States, it doesn't matter what the tax rates are, and we're talking about tax reform right now. If they're getting 20% off the premium, that's a big deal. And when business owners hear tax deductions, they want to explore long-term care solutions more. So there's a number of reasons to do business situations. In my opinion, this is the best opportunity, business owner situations, if you work with advisors in that marketplace. So just very briefly on the 1035, just to kind of give you a little bit more details, the way it works is you would take the client's existing non-qualified annuity or life policy. You're allowed to take both the principal and the gains and apply them towards a single premium long-term care insurance policy. Now, why is that so important? Of course, if they are to use their annuity, for example, to pay for long-term care in the future, they're typically going to have to take a distribution out of that annuity and pay ordinary income tax on that. So a lot of times I see advisors doing annuity to annuity long-term care exchanges so they can get the tax-free benefits. But this is even better than that, because when you actually exchange the cash value from an annuity to pay for long-term care, the benefits from long-term care are received tax-free, and therefore any of the gains in that contract never get taxed, but yet you might get 10, 15, 20 times protection. So it's really that leverage effect, and the gains are going towards creating that leverage effect where you've taken away that tax liability at the same time. So first and foremost, it's a funding source, which is really important. Identifying that balance sheet and that funding source is number one. But number two is this tax advantage that advisors always want to learn about and use. And then, of course, benefits used to pay for long-term care are reimbursement-based, so they're tax-free. Now, we're going to talk a little bit about return of premium in a moment here. Some people like to add return of premium to this. So if you don't use your long-term care, you get your premiums back as return of premium. And that has some tax consequences to it. The basic return of premium is not taxable because you're only getting the premium you paid into it. When it comes out of a deduction or a tax advantage, you'll probably want to talk to the client's tax advisor. The long-term care benefits are received tax-free. If there's a residual return of premium amount, you might be paying tax on whatever you deducted or what you would have paid tax on in the first place, but you're paying it 30 or 40 years later potentially. So there's still an advantage to doing it. It's just the time value, borrowing the money for 30 or 40 years at an interest-free loan, if you want to think of it that way. So it has to be non-qualified funds to be tax-free. We see a lot of people using IRA and 401k funds after tax to fund long-term care plans, but for the tax-free, it needs to be non-qualified. Here's the key thing about it as well is it has to be the same owner and same insured. So when you're using the joint product, you want to have a joint annuity or life insurance policy to transfer into it. When you have a single product, you can use a single annuity. So we tend to see more single policy designs at this time. We're looking to add the potential to this opportunity next year, so you'll see some new options next year as well on this. And then, of course, the single premium is really important because people that say, okay, I don't know about traditional long-term care because of the rates, have the guaranteed premium. Business owners, again, you're going to get the tax deduction because it's health insurance. Benefits received tax-free, again, because it's qualified long-term care. And this is key in that you have flexibility on the plan designs. And I'm going to show you the Benefit Buddy tool so you can get a sense of the flexibility there. But no business owner situation is, cookie cutter. If you're working with C corporations, it'll be a percentage deduction, and I'll tell you a little bit more about this. If you're working with small businesses, it will be a dollar deduction. So we tend to see more affluent plans, more bells and whistles, lifetime benefits, 5% COLA when it's fully deducted. We tend to see more affordable budget-based plans when it's dollar deducted. Okay, so I'm going to show you a few designs here, but any business owner can take advantage of this. That's the key thing to remember. That's really the only question you need to ask. Do you have business owner clients? They need to take a look at their long-term care planning now. So here's how it works, again, in general. As I mentioned, C corporations are taking the deduction through the business. So whatever their corporate tax rate is effectively what they're saving off their premium. So let's say the corporate tax rate goes down to 21% now. They'll save 21% off their premiums by buying it through the business. So again, two big things about this. First is the source of funds. Using the corporate checkbook, a lot of clients don't feel like they're paying out of pocket, if they're paying it through their business. So it's a great way to identify a source of funds. Second thing, of course, is the tax deduction, and that's just kind of extra on top, 21%. It's what's going to get them to listen to the opportunity in the first place. It's what's going to get them really excited about this option. Now, for small businesses, I personally believe that those are a bigger volume-based opportunity because there's about 25 to 30 million S-corps, partnerships, and sole proprietors in the United States, and they all are allowed to take this deduction. The way it works for pass-through entities is they're actually deducting their health insurance as a self-employed healthcare deduction, which is line 29 of the 1040, generally speaking. Okay, so when you do this deductibility, they're paying it through their business. It actually is deducted on their individual tax return. Okay, it's not an itemized deduction though, so you're the first dollar you can deduct, just like health insurance in the same location. And the deduction, the only limitation on it is it's limited by age up to these dollar amounts, which is why I call it a dollar deduction. So they're going to take this dollar amount off of their income that their business earned, okay, and then they're going to save whatever their marginal individual tax rate is. So this might be as much as a 35% deduction, depending on how much of the premium is covered by these deductibility limits. And we'll cover a few case studies here, but the high-level item and why this is so important today is that these limits have grown with CPI, healthcare, inflation. Okay, so what the limits are today are about double what they were 15 to 20 years ago. So when we look at our joint policy, and you can take it per person, you can cover both the business owner and their spouse, you'll see that the deductibility between ages 51 and 60 is about $3,000 a year, And between 61 and 70, it's about $8,200 a year. And again, these grow every year. So next year in 2018, these have grown another 2%. What that means is that the premiums that you're designing on average today really fall within this range, 3,000 to 8,200, especially, with the 10 pay, he'll be on the higher end of this, which means that in a lot of cases, this might be fully deductible for a small business. It doesn't matter what the number is, it's going to be a different percentage for each person. It's generally at least 10, 15, 20, 30, 40%. Okay, so it's going to matter, and it's going to be a tax deduction, so they're going to want to look at it. Don't worry about the exact number. It's going to be significant in almost every situation that I look at. So we'll cover that in a little bit more detail. I'm going to jump back to the high-level features again, because I alluded to this. In today's world, and you guys, I know this more than most out there, asset-based plans are becoming more popular. And again, it's because the sales process can become a lot easier. Okay, so we offer a return of premium option on a long-term care policy, which means that if they use the long-term care, they get their long-term care benefits. But if they don't use the long-term care, they get the money back as a legacy, as a death benefit to their beneficiary. And you can also add on to that an 80% cash surrender option. So if they want to quit the policy and they want liquidity, they can get 80% of their premiums back, the full 80% after the 4th year. So what that means is you have a policy that looks very similar to a MoneyGuard asset care style policy, live, die, or quit benefits. Now, the reason that it's a little bit different on traditional long-term care is because it's actually taking away a fear factor when you have lifetime pay. So, of course, clients are going to use single pay and 10 pay to help mitigate the fear of rate increases, to provide that guaranteed or almost guaranteed premium. But lifetime pay is desired by a lot of those folks. And when you add return of premium to the plans, what happens? You either get long-term care benefits or you get all your premiums back, which includes any rate increase if it were to occur. So you're always going to get at least your premiums back, which again takes away the fear of rate increases, even on a lifetime pay plan. So it's a new way of thinking about return of premium because, again, traditional designs haven't typically promoted this feature, but asset-based planning has made this quite relevant now. So we're going to look at some return of premium solutions too. So asset-based long-term care planning, why does it make sense on a traditional plan? Well, we talked about 1035 exchanges and business owner deductibility. For life insurance, you're limited in that you can't take annuity funds into a life policy, and you can't take a business owner deduction on the life insurance benefits. But because it's traditional long-term care, you can take the deduction with this plan with return of premium on it. So it's got that big advantage, and it's going to be a whole new marketplace for you guys to explore. So I'm going to show you these features visually in a few moments, but I do want to talk about the steps that I recommend for designing a plan today. Most traditional long-term care, I'll say BGAs and producers and advocates, they tended to have followed a different approach than what's being more effective today. They used to offer lifetime benefits and 5% COLA almost by default, and the reason for that is it was so inexpensive, as it turned out too inexpensive, which is why we see rate increases. But today's world, of course, people aren't buying lifetime and 5% COLA hardly nearly at all, okay? So it's a much more of a minority sale. And they're still using the cost of care and they're working backwards, but they're quoting a premium that's $3,000, $4,000, $5,000, and the client might have only been expecting to pay $1,000 to $2,000. And so their first reaction is, of course, this is too expensive. But once you see the value proposition in those plans, and we're transferring $2, $3, $4 million of risk, the client probably would have bought that plan, but you lost them at the beginning of the process. So I am much more a fan of a budget-based approach, and I'm going to show you how I approach this in a minute. And then when the client sees the value proposition, they'll buy up the benefits themselves. They'll ask the question, can I buy more protection? Okay, so as long as they understand the budget, then you can tell them about the cost of care, and you can figure out what's the right fit, between those two things. So the steps are, in my view, make sure you understand their planning needs, because even if they see $2 to $4 million of benefits, if they don't think they're going to use that, of course, they're not going to form their plan. And the plan has a lot of benefits to it, mostly for the family and the consequences of long-term care. And if you don't have a plan, of course, it falls on your family. So that's really what it's about, the need. And then, of course, the cost of care is a part of that. Now, the second thing today, as I alluded to earlier, is if you pre-qualify all of your clients, you'll know exactly which product to offer, and you'll know exactly what rate class they'll qualify for. So I see producers, they're just hesitant to ask their clients questions about their health. But make sure you pre-qual. We have a very short 2-page form you can just have the client fill out without the advisor even needing to see it. You can submit it directly to an underwriter. They'll give you an answer within a few hours as to exactly the rate class. So there's no like hidden secrets about what works or what doesn't. It's all transparent, and in the underwriting guide, the process is actually pretty smooth as well. You know, we rarely do fluids or anything like that. It's not very invasive. The problem we have is that it seems counterintuitive for the client to want to disclose their health conditions to the insurance company. Okay, now on the back end, we're getting all their medical records, prescriptions. We're doing a phone interview, typically under age 65. So we learn about all the medical conditions anyway. So the reason why the client needs to be honest, and this is what the producer has to talk to the client about, is if they get the wrong plan designed for them, they're going to end up with a solution that's not optimal, right? And we're using the pre-qual to figure out the right type of plan. Also, if they get declined, it goes on their, permanent record, so to speak, and it might affect their ability to qualify for other products. So it's in their best interest to be kind of upfront about this process, because there really isn't any, slippage in terms of what people know about themselves that we don't find out or ask about. So that's critical. But again, it's kind of a new way of thinking about, I will say, the health assessments. This is in the client's best interest to do this. And then third and fourth have to do with the funding that we talked about. So the first one, of course, is understand how they're going to fund whatever plan it is they're designing, whether it's annual pay or single pay. Understand, what are their retirement funds going to be. This is why I love working with financial advisors in particular, is they typically know the client's balance sheet already. And so they know what's allocated towards paying for their living expenses into retirement. And you can actually use, obviously, a source of income in the future to fund it. You can use a balance sheet asset, but know where they're going to fund this, because that often helps you determine the budget, right? If you know the funding source, all of a sudden, if you say they have $100,000 in a CD, that's $100,000 to use to fund their long-term care plan potentially. But maybe they only want to use $50,000, and you can form really good plans that way too. Once you know the budget, make sure you start off there. I mean, that's really about meeting clients' expectations. If you deliver a plan, they say they want to spend $1,000, and you deliver a plan for $1,000 to start off with, that's a good conversation to have, because you have a starting point. They have something that they would choose instead of saying, I'm not going to insure this at all. And then you can work up from there to maybe what is more towards the full cost of care. Okay, so it's going to be maybe partial coinsurance for facilities. It might meet the full need for home health care, but it's going to create this plan, and it could just be a starter plan for them. But don't worry, even if it's a low premium dollar amount, the advisor shouldn't say, oh, this isn't worth my time, or, to focus in on this. You have a lot of people out there that need a plan, and a lot of them are going to end up buying a $10,000 plan instead of a $1,000 plan once you begin having the conversation. So this is the pre-qual form. Again, this is the 2-page, 1-page front and back form. We'll send this to you guys so you can use it. So the product today, just as a high-level summary, and again, I'm going to show you the features in a minute, it addresses a lot of objections about long-term care, and that's why this new product is so important. It has so many different things on it that you've just seen that really weren't available in the market until we launched the product, that have filled gaps in the marketplace. So the biggest two objections about why people aren't buying long-term care, are, in my opinion, are the first two. Long-term care is too expensive, or it may become too expensive, and you have ways to take away those fear factors with the product here. The third one is I might run out of benefits, of course. In today's world, people are buying more limited benefits, but with joints, we have an ability to add a lot of benefits to the plan at a much more affordable cost with the third pool rider. Use it or lose it, that's where the asset-based plans come in, and we have that option with return of premium. And then, of course, clients always say, the excuse for not funding a long-term care plan is I have enough money, I can self-insure the risk. But given the tax advantages, the tax-free benefits, the deductibility, it doesn't make sense to do that. And today's investment environment is such that it's very hard to accumulate assets at a high rate of return that is equivalent to the amount of protection you're covering with the long-term care solution. Okay, so I'm going to go into Benefit Buddy. So some of you might be seeing this for the first time. You can download this tool, and this is my favorite way to introduce and train on the product, is actually getting your hands dirty with it, so to speak. Running actual clients through this tool will show you instantaneously what the value proposition is and all the features we just covered. So there's a lot going on in the plan, but this tool allows you to explore everything, okay? On the left-hand side of the screen, what you'll see is your planning design options. So you choose, the demographic, state, age. If you have a joint, we use the older age. Okay, that's why there's only one age here when I select the joint. comprehensive coverage is almost always selected for the home health care benefits. The risk class you'll select, and we have 3 choices for that: preferred plus, preferred, and standard. If they're a joint, you might select one of each, and that's why these 3 are down here. Now, what's different about this plan, again, because we tend to emphasize that this is for people that have longevity risk, that tend to be healthier, preferred plus is utilized about 40% of the time. So once they qualify for the plan, about 40% of our clients get preferred plus. It's much higher than the industry average, which is around 10 to 15%. So you will be quoting preferred plus more often. Preferred is used about 50% of the time. Okay, so you're almost always quoting either preferred plus or preferred. If you want to be conservative, feel free to quote preferred, and after the underwriting, we'll actually upgrade them automatically and allow the advisor or agent to lower the premium and send the client back money, or raise the benefits to again hit the budget. So you have that option post underwriting. So don't worry about necessarily quoting it conservatively. We'll upgrade them. I would always quote preferred plus or preferred because that's 90% of all the cases. Now, if you have a joint, you might quote one of each. That's probably our most common approval, really, is preferred plus, one preferred. And the younger they are, the more likely, of course, they'll qualify for preferred plus because they have fewer cumulative health conditions. As they get older, you'll probably want to quote preferred more often. When you do competitive analysis, just keep in mind that preferred plus does give a big discount, so you want to make sure you do it head-to-head, in a way that you think is going to be realistic for the client. So competitively, I often quote preferred plus. When it gets down to applying for the policy, I usually set the budget a little bit higher, more conservatively, and then you have a good outcome. If the client likes that plan, you're giving them a good situation after underwriting almost always. So that's kind of how the ratings work. Now, this tool, I'm going to start off with an age 50 female, and I like to do that for a couple of reasons. One is it's just to show you how affordable plans are and how much leverage you get if you plan early. But the rates are relatively flat, especially with inflation, between 50 and 65. Okay, so even this budget is going to be manageable even as they get older, and we typically see people between 55 and 60. That's our average. Okay, so I'm going to start off with a basic plan design just to show you how affordable long-term care is and what value there is with a basic plan design, and then I'm going to morph this into the more common solutions that you'll find, the affluent solutions that you'll be wanting to offer. Okay, so this is going to start off with $100 a day, roughly $3,000 a month. We have a daily benefit on this. Okay, it's going to have a 90-day elimination period, and it's going to have a 3-year benefit period. Okay, I'm going to change all of these factors in a moment. This is going to start off with no inflation, and what this tool allows you to do for the client is really to form a plan for them. Typically, they're planning to use these benefits between 80 and 90. The younger they are, like at age 50, I'd use 80. They get older, like age 60, I use 85, and sometimes, especially for females, I'll use an older age like 90 if they're above, 60. This also lets you cut off the projection, which becomes relevant with the lifetime benefits, and I'll show you that in a moment. So with this particular plan, the cost of it is $647 a year, and over 30 years, from 50 to 80, it's $19,000. When they go on claim, they have waiver of premium benefits, so they're actually not going to pay premiums once they're on claim here. Now, the benefits available at age 80 is 109,500 pool of benefits, which is actually the 100 times 365 days times 3 years. Okay, so they're going to get about 36,000 over the 3 years if they used it in full. If they don't use the full 109,000, the benefit period actually does extend out until they use the full amount. So this pool is actually what they're getting on a reimbursement basis. What that means is if they use all their benefits and pay all their premiums, they're going to get about 5.6 times the premium they paid in the form of benefits. So there's quite a bit of value and leverage on this plan. It'd be very difficult to take $647 and earn $109,000 in 30 years in your own self-insurance pool. But again, this is protection only if you qualify for it, and that's the big difference. So 5.6 times, that's pretty good. I'm going to show you what looks spectacular in a moment. This is the joint plan design. Okay, you're going to be a little surprised. Look at the premium here, $647 with our joint plan. Guess what the cost is? It's still $647. Okay, that's not an error. The way we price the joint product is we use the same rate as the female rate. Okay, so we use the older age female rate and then the rating class for each individual on these plans. So in this case, 2 50-year-olds, let's say, it would be buy the female and get the male for free because they're each getting their own pool of benefits each 3 years. So we've doubled the total maximum benefits available for them, And this ratio also doubles, again, if they both use their benefits in full starting at age 80. So it really kind of visually shows you the value of the joint plan designs here. Remember I mentioned that shared benefit rider? It offers that third pool of benefits, and what you see when you add that on is now we have a third pool of 3 years, a total of 9 years for the two. They never use each other's benefits, okay? So they only use their own 3-year pool, but if they run out of the 3, they can share an additional 3 years. The cost of these shared benefit riders are very affordable, such that when we look at the cost relative to the extra 50% more benefits, it's 14 times instead of 11 times. This is one of NGL's biggest competitive advantages. So if you looked at, let's say, Mutual of Omaha's product as a comparison point, and that's just the best product on the market. Others have the same shared benefit as well. They're usually using each other's benefits. So they only have a total of 3 and 3, 6 years. With the third pool here, they have a total of 9 years. So when in competitive situations, I often see people quoting our shared benefit against Mutual of Omaha and looking at price. And by the way, our price is probably going to be less expensive, but you have to keep in mind they're getting 50% more protection. So there's really nothing that matches up to that competitively. And we look at asset-based situations, I think you'll find a lot of value because you can design these plans in any combination with the return of premium riders, and you're going to see that flexibility here in a moment. So we have a 3-year plan. This is a pretty common design. This is $800 for 2 people, though. I mean, that's really affordable. Again, getting to that budget point. Most people should be buying inflation on these products, and this tool shows you why. You add on 3% inflation. We have 3% compound and 5% compound. You'll see that the premiums go up, but also the benefits are increasing by 3% compounded over 30 years. They continue to increase while the person is on claim. And that's the reason you actually notice the third pool here is a little bit bigger than the initial pools. And that has to do with the fact that inflation is continuing to increase. Let me show you on this projection tab, which shows you exactly how you design the plan, why that happens. You'll see how the benefits accumulate over the 3 years starting at age 80 here, each person. But they have to use their first 3 years. So by definition, they're not going to get to the shared pool until 3 years later, and you still have that inflation building on it. Okay, and that's why the third pool is higher. So if you ever have any questions about what you designed, jump over to this projection tab. It's going to show you how the return of premium works and all the other features, exactly how you customize the plan in this tool. So $50,000 of total premiums, $850,000 of total benefits if they're used in full. That's what you'll see in this chart here too. Now this is 17 times value, which of course people don't believe that long-term care can be this affordable. Okay, that's the main thing that I run into is I don't hear long-term care is too expensive when advisors look at this. I hear this looks too good to be true. And that's, of course, what you want to hear when you're offering a product, like this is, okay, that's a lot of protection. I can see why my client needs to put this plan in place here. Now, the other kind of competitive advantages for NGL are when you extend out the benefit period. And so you'll see there's going to be more and more value on this plan as we extend out the benefit period. Of course, now it's 12 years of coverage for the two, 4, 4, and 4. This actually might look like a MoneyGuard style solution, which has 6 and 6, but a little bit more flexible because they could use it 4 and 8 or 8 and 4 because of the shared 4 years. But now we have over 20 times. What do you think about when you see the asset-based plans? Typically, they're offering between, 3 and 8 times. So traditional long-term care, this is why there's so much value on these plans, is you can get them to a much lower price point because of how much protection you can get from just these basic plan designs. I like the 5 and the 6 year, again, because that third pool keeps growing. It's 5, 5, and 5 now. Now this jumps up to 26 times protection if they use the benefits in full. So as you extend out the benefits, you're getting a lot more benefits that's starting to look like almost lifetime benefits. We're getting closer and closer to that, but the cost is still under $2,000 for 2 people. Let's jump into more affluent solutions. I'm also going to up the age here so you can see kind of how this changes with age. For an age 60-year-old couple, I'd probably use age 85 here. And when I do 85, the numbers are going to change here because we're projecting this over a different time period. Let's do age 60, though, for this couple. We went from $1,900 up to $2,400. So you'll notice we went up 10 years, but it only went up a few $100s for the same types of benefits here. The compounding from age 60 to 85 is only going to be 25 years. So this is compounding at 3% for 25 years now. But all those calculations are done for you already. Again, you're paying the premium only over 25 years, so it's $61,000. You're getting over $1 million of total protection for the two. So still you're getting over 20 times value. Now, people are probably going to be buying, at the end of the day, more towards the cost of care. Again, start with the budget first. If they tell you they only want to spend $1,200, which I can see is about half of this, I would have the daily benefit because this keeps the value metric intact. It only gives them $105 at age 85, but that's going to help provide a lot of home health care coverage, and it's going to be some percentage co-insurance towards the facility. And again, it's going to start off with a plan when they might not have purchased anything to begin with, because based on the budget, they only wanted to spend this. Now, again, this is covering 2. Now, this is the point where you might start upping the coverage more towards the cost of care. So if I go up to 150, again, the value metric stays intact, but now we have almost $2 million of benefits. Still affordable, $3,600 for 2 people. That's probably well below the average, but now we're getting quite a bit of protection and at an affordable price. So here we're going into some more affluent features. The first one that I want to show you is the 10-pay. $3,600 over 25 years is $91,000. With the 10-pay plan, we're only going to pay it over 10 years, and the total premiums are actually only going to be $87,000. So $8,700, but for 10 years, $87,000. So the first thing you'll notice is that even though we're mitigating the fear of rate increases because it's paid up after the 10th year, the actual premium total dollars is less. And again, this doesn't take into account the time value aspect, right? So from an IRR perspective, the lifetime pay is going to give you the best, I'll say, value IRR-wise. But this is not priced with a tremendous amount of risk margin. And again, your total premiums tend to be less when you buy 10-pay. So it's really a good solution and very popular with us. The single pay is going to show you the same effects, but you're front loading it, so it's one premium. Again, less expensive in total. You pay all your premiums up front, so $84,000 here. So when I do this design, the first thing that comes to my mind oftentimes is this is what people are looking for when they're buying a single pay asset-based product sometimes. You know, the repositioning assets, they want a guaranteed premium. They want the most long-term care protection that they can get. And so this one, I would say, is pretty popular. The equivalent asset-based solution that has $2 million for 2 would probably cost closer to $200,000, okay, because you're getting that extra life insurance piece. So again, as long as they're okay just getting long-term care protection, this is going to fit a new marketplace that a lot of people aren't exploring today. And again, you can build this so that the single pay is very, very inexpensive, you know, under $30,000 for a one-time premium payment. So if you have orphan life insurance annuity policies, that's where, you know, these might be good solutions for them. You can build this as little as, you know, $5,000 to $10,000 single premium, just to give you an idea if you take off COLA and some of the other features here. I'm going to go back to 150 though. Now this is, because we're thinking about asset-based plans, I wanted to show you how the return of premium feature works here. Okay, you're adding on one rider to get this life insurance style benefit. Okay, it's not life insurance, it's still traditional long-term care rider. But in this case, if they use the long-term care benefits, they get the return of premium reduced dollar for dollar, just like an acceleration rider. But if they don't use the long-term care benefits, they get the return of premium back to their beneficiary. So there's no use it or lose it here. Okay, so that's what really takes it away. This is going to be that asset-based solution. There's a feature on this called a cash surrender option, which costs 10% more. That gives you the liquidity as well. So after the 4th year, they can surrender the policy and get 80% of the premiums back. $154,000 lump sum is a big chunk of change. If they're worried about getting locked into the plan, this is what gives them that, you know, that peace of mind, liquidity. They need to get their money out, they can get 80% back. So the cash flows on this literally look like a life insurance with a long-term care rider. Long-term care benefits, a lot of leverage, getting return of premium back, and getting 80% surrender, again, if they want to quit the policy. The nice thing about this being traditional is you have flexibility to design whatever you want here. We can do this with lifetime benefits. So if we choose the lifetime benefit option here, you can see the cost. Again, now the benefits are unlimited. Now, the reason that there are numbers here on the lifetime benefit in terms of pools, even though there are unlimited benefits, is this is going to calculate for you what a claim would be starting at age 85 and ending at 100. So that's 2 15-year claims. But you can change this ending age to whatever you want. So if you do 95, this will show you how much protection it would be for 2 10-year claims, let's say Alzheimer's claims. Of course, you're always going to have really good value on this. We change this, let's say, to 88, like 2 3-year claims, more like the average. You're still going to get 3 times protection and all your money back if you don't use it, even though you have unlimited benefits here. Okay, this is if you just use 3 years, this is the calculation. So again, the break-even point for traditional long-term care is probably under 6 months where you get your premium back in the form of benefits. It's a really short period of time. And people are really surprised. Wow, it really doesn't take much time on claim before I use up, all the benefits that cover my premiums that I paid into it. With the ROP, it's probably closer to a year, but still under a year for that break even. And by the way, if you want to see what that is, go to the projection tab, and it's going to show you this is the total benefits. This is the premium with the lifetime benefit. It takes less than a year before you use that up, and it gets reduced dollar for dollar. So if they both use their benefits in a year, they won't have any return of premium after that. This shows you how we cut it off after 3 years. We go back to age 100 here. We go back to this tab, you'll see how it continues to go out here. So again, use this tool to explore the plan and some different options here. Now, the other thing I like about this, I'm going to go back to the 5-year shared care. It's just kind of in the middle of the ones we're looking at, is a lot of people want to amortize this cost, right? They want to spread it out because they have a source of income that's going to pay for the plan. And again, that's where you need to know the funding source. And they want to buy a lifetime payment option. And we're seeing a lot of carriers, One America, MoneyGuard, looking at how do I spread the cost out so that it's a lifetime pay, because there is a lot of demand for this. Traditional long-term care, because it doesn't have to follow life insurance regulations, because it's a health insurance product, we can build this in so many flexible ways that we can do lifetime pay just natively in this. So you choose lifetime pay. This shows you the cost for the lifetime payment option. And then again, going to the projection tab shows you how the return of premium accumulates as you pay in your premiums. So I like to use this, as I mentioned earlier, because people that say I'm worried about rate increases, oftentimes they still want lifetime pay and an affordable plan. They can actually build it so that they have ROP, so if they get a rate increase, even though we don't expect it to happen, they are guaranteed to get at least all of their money back, including the rate increase, either ROP or long-term care benefits. So this is kind of that new feature, new marketplace there. And again, I'm going to hit their budget. So if they say I want to spend $3,000, I'm going to lower the daily benefit. This is $2,200, so I have a little bit more room. Let's do 70, maybe about $70 a day gives me the $3,100. This is how I do that budget approach. And it will show you again at age 85 what that accumulation with COLA would be. So explore this. I use 5% COLA a lot more often than most people do, and that's because the cost of 5% COLA for older people becomes a lot more affordable. For our joint plans, that also means each of them get 5%, even though we're only using the older age of the two. So you'll find a lot of interesting situations as you explore this. So this would be 3% COLA cost for a single pay plan with $70 a day. I'm going to do 5%. So this is $126,000 at age 60 for a joint. And all I'm going to do is change the age to age 70. The $126,000 is actually less expensive as they get older. Okay, a little counterintuitive, but it has to do with the fact that we have 5% COLA and less time to accumulate the benefits to age 85. Okay, but stick with me. If they are 70, let's say an older husband, and the wife is 60, she just got 5% COLA for a lower cost. So again, a lot of interesting ideas, concepts here. This one also has ROP on it, so they get their money back. I know we're talking about a lot of different things here. This is why I want you to look at this when you're doing some cases, because you'll find some new opportunities that you might not have recognized before. Rachel, I'm going to just briefly talk about business owner and 1035s. Is there anything else you wanted me to cover, though? I don't want to go too long.
I think that's it on that. I wanted to let you know I've got an 11 o'clock call I've got to host. So,
okay.
And some of these people have to be off, so we don't have a whole lot more time.
Okay. All right. Well, here are the key takeaways from this. If you have a joint annuity, for example, you can take $114,000 out of that annuity tax-free to fund this plan. That's the 1035 exchange. If you have a business owner, let's do it at age 60 here, and I'll do the 10-pay option. And let's say they're a C corporation, they can deduct the $13,000 as a business expense, and basically they're saying 21% off the plan. That's their corporate tax rate. If you have a business, and this is 5% COLA still. If we do 3% COLA, let's say we take off ROP, now more of a middle market plan. This still has 10-pay on it, by the way, really good value. And you're a small business, you can deduct the $4,100 through their business, and they're going to take that off of their individual tax return. And because they're age 60, they can deduct this in full starting next year. So again, save another 35% off the premium, by doing this through a business owner. So I would say if you've got to start off anywhere, ask your advisors, do you have business owners that need to get their long-term care plan in place? Do you have clients with existing annuities that they're not really using? They're using it for accumulation, and think about repositioning those assets. Those are the two low-hanging fruit starting points, and I think you're going to find a lot of success exploring those markets. So that's all I have, Rachel. If there are any questions, I can take them, or I know you guys have to jump off here, so we can always do a repeat session. I think we have one scheduled in January to talk about some more details.
Thank you, Mark. So if you guys have questions, hit the raise your hand button because I think most of you are muted. I'm going to try to unmute you. One thing, too, is we make sure that everybody, I think Misty has the instructions and I have the instructions, but just in case, I'm sure they're going to want to know how to download this Benefit Buddy tool so they can play with it themselves. And I'm trying to unmute everybody, but some people have really bad noise.
I would suggest just email everyone out a copy of the tool. By the way, you can get access to the NGL website, and you'll be able to access all of the marketing flyers, all of the tools, the state availability map, which I just pulled up here. We have a number of recorded webinar trainings on all these concepts. You can listen, to different features at your own pace. How do you work with business owners? We have like 3 webinars on that. So get access to the website. I would say that's important. You'll want to run illustrations here as well. If you do run your own illustrations formally for the clients. But this is where you can get the premium calculator. I timed out, but after you log back in here.
And I bet we have a generic login that they could use that we've already set up that Misty's using too.
Yeah.
Wade, you're on the phone. If you could find that out, you could probably send that to the group. I bet we have a generic one.
Okay.
Absolutely. Feel free to do it that way. I recommend everyone get their own login because you can customize the experience in the future, towards your preferences. So we're headed in that direction with the website. But yeah, feel free to, whatever you need to get access to the website, go ahead and do that. And this is really where you can find all of the available resources all go onto the website here. So there's probably going to be another couple of dozen, things coming out next year in 2018. And so you'll want to kind of come back to here just to see what's new. On the home page, it will tell you kind of what's new on the website right here, as well as what webinars we're doing and other things.
And Mark, I've got a text from Kelly. She says, do you have any guaranteed issue for business owner groups, high earners, or executive benefits?
Great question. And we have a lot of different markets here. The worksite market, currently, everything we do is fully underwritten. So it's a little bit of a different process. Typically, you start with the business owner, and you want to make sure that they're going to qualify. They become a big advocate because of the tax deduction and the value. Then they go to their key executives, and they want to offer an executive carve-out. So you're underwriting every individual, and typically you have a backup product, like an annuity long-term care product, in case they don't qualify. So you'll have 2 offerings so that you never have to say no to the executive, but you'll be offering, 80, 90% of them probably the traditional plan, because most people do qualify. And it does cover them and their spouses. For the worksite situations, we have a unisex product coming out next year. So you can do broad-based worksite, but again, fully underwritten. So it's a little bit of a different approach than what most I'll say HR directors have been accustomed to. So it's almost like a new marketplace for long-term care in the worksite. On
the execs, do you have a minimum?
Actually, I didn't even show you. We have a 5% discount available for groups. As long as they have at least 5 employees, there's no minimum. Only the business owner has to apply for coverage, and you can get a 5% discount in addition to that.
All right, so you only have to have 1 apply, but you have to have 5 people employed. That's the key.
Correct.
Okay. Makes sense.
Yeah, and by the way, in Ohio, it's 2. They have a regulation in Ohio, but almost all states, it's 1.
Okay. Any other questions out there from the group? You can send me a quick text message, or if that's easier for you, or hit the question mark box if I wasn't able to unmute your phone.
Yeah, as you get into advanced market situations, you'll want to obviously talk to the client's tax advisor. We can't give tax advice, but we'll help you direct you towards what are the common treatments. And then, you can work through it with the client's tax advisor. Once they're in the loop, they'll figure it out, because the business owner deductibility is pretty straightforward in the tax code. It's just when you add some of the bells and whistles like ROP that you'll want to be exploring that a little bit closer.
Wonderful. Any questions from my internal team? Wade or Alan?
I'm good.
Good.
I'm good.
And I think you guys have the tool, the buddy tool, and have the all the sales pieces.
Perfect.
All right.
Yeah. And what we do is, as a follow-up to the webinar, typically we do a workshop, and what that means is we have lines open, and you bring in client case studies or producer case studies with you. and we'll actually design them with you with the tool and answer the questions that you have, because there are a lot of things to learn as you're going through this for the first time. We want to be there to make sure you get all your answers.
Absolutely. Sounds good.
All right. Well, thank you guys for being on. I will send this recording out to the entire group if you want to rewatch it, if you missed anything, or for the guys that missed the call today. So, Mark, thank you for your time today.
You're welcome. Thank you, guys.
Thank you.
All right. Bye, guys.
Bye.
Bye now.